Fed revising higher its inflation expectations, revising lower its economic projections, but leaving in place a dot plot that suggests at least 2 rate cuts later in the year. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostic.
And I'm Alex Steele. We're 10 minutes to the closing bell. You know what's happening in the market? Absolutely nothing. It was a snoozer in terms of market reaction, probably exactly what the Fed wanted. S&P up 0.1%. The VIX a little lower here. You're having a bid into the bond market. And by bid, I put that in big time quotes. The 2-year yield down just 1 basis point, and the dollar a little bit higher. But honestly, super calm.
Super calm here. And of course, rates staying exactly where they are, 4.25 to 4.5. We're basically where they've been at each meeting so far this year. We had a chance to read the statement and we had a chance to hear from Jay Powell. Here's what he had to say.
Despite elevated uncertainty, the economy is in a solid position. We expect a meaningful amount of inflation to arrive in coming months. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are. The current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments.
And that all left the market somewhat listless as we head towards the close. Modest gains in equities, modest gains in treasury prices, and just a smidge of gains for the dollar. Ken Shinoda joins us right now, portfolio manager at Doubleline Capital. And Ken, it's been quite a ride for markets, really, when you go back to 6 weeks ago in that last Fed meeting, an S&P that continued to rally. We briefly saw long-term yields above 5%, short-term yields above 4%. Based on what we learned today, I am curious as to where you see the direction right now for yields, particularly on the short end of the curve.
Yeah, well, we're kind of in the middle of the trading range. It's funny. I had a call with a client who was asking about, how high rates have gone, and the 10-year has kind of been in this trading range, kind of 380 on the low end, up in the high 4s, close to 5 on the high end, and we're kind of right in the middle of it. So with the Fed on hold, I think, I'm kind of neutral on long-term rates. I'm negative on the long end because of fiscal risks, but I think the 10-year is kind of a neutral view here. I'm not too bullish. If we get up back towards that kind of 4.75, 5%, maybe that's more of an interesting buying opportunity. But I'd rather hug the front end of the curve right now. I think you can find a lot of opportunities off the 2-year, some short, high-quality credit where you pick up 100, 150 basis points over the 2-year. And that's a great place to hide out and wait for a better buying opportunity.
I am curious about the differential between what we're seeing with the Fed funds rate and what we're seeing in the secondary market. I mean, there's not a big differential there if you just take, obviously, the benchmark 10-year at, 4.3869, and you have a Fed funds rate kind of right in that spot. Does that mean that the markets and the Fed are aligned, or is there a mismatch there that we should be paying attention to?
Well, the market thinks the Fed's gonna cut. I was actually kind of surprised that they kept the dot plots as is. I thought they would be a little bit more hawkish given the spike in oil and the geopolitical concerns, the tariffs. But I think what they're signaling to the market is that, the dual mandate that Powell talked about over and over again today, which is obviously keeping inflation down and keeping unemployment up. It seems like he's more concerned about unemployment, and that's why he wanted to keep those 50 basis points of cuts on the table today.
Ken, you brought up Iran for a second, and you were talking about not loving the long end of the curve. Does that mean that the Treasury market right now can't really be that safe haven asset that we're used to?
Well, it's held at 5%. We had a couple of weeks of the fiscal fears out there, but I think the geopolitical tensions are helping yields come down a little bit here, and that's why we are kind of at that 480-ish level on the long bond, or sub 4.5 now on the 10-year. So it's one of those things that it'll work if growth slows down, but to the extent that growth doesn't slow down and fiscal fears continue, then I think you could see a continuing steepening of that yield curve.
What about the credit market? How much risk do you want to be taking on when volatility could really pick up in the equity market and could spread if we have continuation of disturbance in Iran and Israel?
Well, we had been upgrading our portfolios for the last couple of years in hopes of a little shakeup, which it looked like we were about to get in April. And we saw some spread widening, but the fixed income markets and the credit markets in particular were way more contained than you would have thought of if you looked at price action equities. We had those couple of days when stocks were down about 5% a day. And while we did see high yield spreads widen, they widened from very tight levels to about average. And so we never really got that dip buying opportunity for any meaningful period of time. And spreads have recovered with the equity markets. I mean, investment grade at its tights at the beginning of the year was about 76 basis points. It's got to 120. Now it's back to 85. High yield had a 250 handle. It got to about 450, and now it's at 300. So you're kind of almost back to where you were at the tights. So it's not really a great buying opportunity. So I'd rather be up in credit, upgrade portfolio quality. Again, that short end of the curve. You can go into the securitized markets, buy things like asset-backed securities and some commercial mortgage-backed securities, find some attractive spread there, but stay short, hide out, and wait for some things to come.
I have to get your thoughts, though, Ken, on what's been going on in the housing market. And Powell, he didn't address this directly today, but he's talked about it in the past as how that's a huge component of what they're paying attention to. We've had a couple of data points this week showing deterioration in the market, certainly the housing starts today and the home builder sentiment from the other day. As an investor in the residential market, I am curious as to whether that works in your favor or whether you now take precautions.
Well, if you're looking at government guaranteed agency mortgage paper, its supply will be down because people aren't buying homes. But you're not really worried about defaults because those agencies, Fannie, Freddie, Ginnie Mae, they buy out the loans at 100 cents on the dollar. And if you're a credit investor, you're always watching the housing market. Is the housing market going to go up? Is it going to go down? And obviously, if home prices go down, that could be bad for you if you own mortgage credit. But underwriting quality is so high right now, and I think the home prices can soften regionally. They could go down just because supply is finally increasing, and people have just given up to try to buy with mortgage rates so high and affordability low. So I think you'll see some regional softening, but I don't expect a deep decline nationwide. And with mortgage underwriting quality so high, it's not really a worry for mortgage credit.
All right, Ken, always appreciate you jumping on a day like today. Ken Shinoda, Doubleline Capital portfolio manager, helping us count you down to the closing bells. Just about 3 minutes to go, Alex. Stocks basically unchanged on the day. We'll call it that. The S&P had a flat line. So too is the Dow. Modest gains right now for the NASDAQ and the Russell.
I mean, this is a win for Jay Powell, right?
Yeah, and I think that's the whole point, right? Come in, don't make news, don't rattle the markets. But he also seemed to sort of address a lot of the questions about their forecasts and this idea that he seemed to say there wasn't a whole lot of conviction in the forecast, at least by the other members on the committee. And I do wonder if that's going to be the big bugaboo for this market going forward. And
really split to the point where one person changes their view and that's going to tilt the whole committee in what they do. But again, talking about the inflation forecast and sort of talking about it's just going to be a pass through. It's not going to be permanent. It also is that, it's transitory. It's other words for transitory. Yeah, really modest gains or losses right now in equity markets. We should point out Treasuries yields moving slightly lower by only about a basis point or two. The dollar basically unchanged right now as we head towards the close. The full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through to the closing bell with a global simulcast that starts right now. Carol Massar and Tim Stenovic join us in the radio booth. Scarlett Fu has the day off as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube, Carol, on what might be the least consequential Fed day that we've had in quite some time.
Kind of interesting because I was listening to the commentary earlier on our own Fed special, and there was, I think, one individual who said this could be historic because there's so much coming at the Fed. Another one said this is going to be a snoozer. I do feel like the messaging we got from Fed Chair Jay Powell is, hey, folks, we'll know more, and especially when it comes to tariffs later in the summer, and then we'll have more information to maybe really figure out monetary policy from there.
Yeah, lost track of how many times the Fed chair said, basically, we're in a really good position right now. We like where we are. We're in a good position. We can move if we need to. That's what I heard.
Yeah, and that really raises the question, what's going to be the trigger point, right? When are we going to see any sort of tariff impact actually show up in the data? And what are they going to be weighing at the end of the day? Is it going to be growth or is it going to be inflation? And which one blinks first? Interesting, though. I mean, they did point out during the press conference that most of the committee members do see a meaningful increase in inflation as we get deeper into the year. But again, to your point, Alex, it's kind of anyone's guess right now as to whether that feed through from the tariffs will actually materialize. Also, one-off is a one-off, right? Again, that's transitory, and we saw the predicament the Fed got into itself with that. So is it a mistake or is that sound policy? Torsten Slok was just on the Fed special. He was concerned because he's talking about that stagflationary scenario once again here, and whether that means that the Fed's hands will be tied, and maybe we don't get much of any action at all. Right now, the market, not doing much of any action at all today here, as most of the markets end the day pretty much
around the flat line. The Dow Jones Industrial Average losing roughly about 40 points. It takes a while for these numbers to settle, but no matter what happens, it's going to be a decline of less than 0.1% on the day. The S&P 500 only down by 2 points, so we'll call it unchanged on the day. 59.80 and change is your closing number. The Nasdaq higher by about 0.1% on the day, and the Russell 2000 higher by 0.5%.
All right, quick check on the S&P 500. Almost an even split, guys. 236 names to the upside. Alex, we've got 261 names losing ground today, 6 unchanged.
Yeah, you can kind of see that in the IMAP function as well. It's sort of a mishmash of what's up and what's down, but not a lot of movement either way. Energy is the worst performing sector, right? Down 0.6%. Tech, the best performing sector, but only up by about 0.4%. So super calm movement all across the board.
Yeah.
I love mishmash.
Mishmash. It's an official technical term. Did you not know that?
I know it now.
It's mishmash go on the terminal. All right, let's get to some of the individual gainers. Coin, number one gainer in the S&P 500, folks, up.
Whoa.
I know. Yeah. I love it when I can surprise you.
I know. I was paying so close attention to Jay Powell. I'm missing all the real action here.
All right. Well, there was action in Coinbase today, up 16% in today's session. Billionaire Michael Novogratz coming out saying that stablecoin legislation will push traditional financiers toward cryptocurrencies. You also had Coinbase introducing Coinbase Payments, a stablecoin payment stack for commerce platforms. And you might remember yesterday, JP Morgan came out saying it's launching a pilot for a token called JPMD, which represents dollar deposits. It will transfer a fixed amount to Coinbase Global on the public blockchain base. This stock is up about 17% year to date. So I just feel like a lot of momentum around that puppy. Marvell Technology, number one gainer in the NASDAQ 100, folks, up about 7% in today's session. Analysts positive on the chip maker following an event focused on AI. At that event, Marvell raised its overall data center total addressable market to $94 billion by 2028, up from $75 billion. This stock, though, is off more than 30% year to date. And one more for you, GoGo.
GoGo.
It's not just a dance from the 60s. Up about 15% in today's session. You know, Wi-Fi while we're flying.
Yeah. Has that improved?
That's a great point. Every time I fly, I can never get Wi-Fi anymore. I think it's me.
No,
but
I feel like it definitely has improved.
Oh, wow.
You don't think?
I don't know.
Depends on the airline.
Wow.
That
It
shall
does.
remain nameless.
Yeah, we're gonna be good today. Shares soaring though on heavy volume. The company coming out saying it successfully completed its first end-to-end call using its 5G technology. William Blair coming out saying those developments represent a significant milestone for GoGo's 5G network. Stock is up 80% year to date, 30% of the float, though, shorted. So investors kind of watching very closely.
Okay, well, the small moves in the indexes really masked some big moves taking place under the surface. I want to start with Wolfspeed, down 30% today. The chip maker shares plummeting. Bloomberg did report today that it will be taken over by creditors, including Apollo Global Management, under a proposal that would put it into bankruptcy to slash billions of dollars in debt. Shareholders could, though, actually recover as much as 5% in this proposed scenario. This is as opposed to what typically happens during a situation such as this, where they are wiped out completely in a bankruptcy. Uber shares also on the move lower today, and this as a result of some Waymo news.
I'm so excited.
Well, don't get too excited
excited.
Just because Waymos will start to be tested in New York with a human driver, this is what drove shares of Uber lower today, doesn't necessarily mean that we're going to be seeing these all over and going to be able to take them anytime soon.
Wait, so Carol's into this?
Oh, my
Carol loves it. I convinced her
Oh my God.
to get into one of these things. She did it. Where were you, in Arizona?
I did it in
Carol?
Arizona first. It was like evening to the airport, closing my eyes. I'm totally comfortable. I've done several since. Oh, Alex, it's kind of like
Alex, I think you're the only one here who hasn't done this.
It almost feels like you get into a spa. There's like this really easy music. The car is immaculate. Wow. There's nobody talking to you.
My face is like,
you're one of those people.
Yeah, struck dumb right now.
You know how Carol feels when, somebody talks to her next to her on the airplane, right?
True story.
No, but
Yeah,
you get into the car and they're like, "Hi, Carol." And you're like, "Hi." Okay, it's pretty cool. Anyway,
All right, Carol
moving
obviously
along.
not concerned about the robot overlords
Right.
taking over.
So
anytime
this
soon.
is in New York?
Yeah, this is in New York.
Oh,
This is
okay.
where they're going to be testing it out, but
Yeah.
only with a human driver behind the wheel. So with the
And
human
I
driver.
assume what, like in Midtown or where is this
I
going?
don't know. We'll see.
I don't know. It's a good
I think there
question.
are a
It's
lot
gonna
of
be tough.
challenges to this service happening like it happens in San Francisco, just due to the congestion in New York. And there aren't necessarily places to pull over, legal places to pull over.
I hate to break it to San Francisco. You ain't got nothing on New York.
Yeah, when it comes to congestion, it's like
Driving in
easy,
New York is
easy
skill set.
peasy there. All right, Waymo shares, or excuse me, Uber shares down 1.6% today. Let's move on to some payments companies. MasterCard fell by 5.4%, but Visa is what I want to highlight, down 4.9%. Both of these companies fell over worries about the impact of stablecoins on credit card issuers. Remember, we saw this on Friday after that Wall Street Journal report that said that Amazon and Walmart were interested in stablecoins. We did hear David Sachs today telling Bloomberg TV that stablecoin legislation would cause the asset class to grow and create demand for the U.S. dollar.
I have an honorable mention. I'm going to pull a remain on you. Walmart, now in its longest losing streak since 2004.
Wow.
Ooh, what's
Take a
going on?
moment. I mean, to be fair, it was on a huge winning streak, so take that with a grain of salt. Bond market, look at that. Nothing. Absolutely no movement there. You're looking at the 2-year below that 4% level. You're looking at the 10-year around 4.38%. There was a breaking headline about a few minutes ago saying that foreign treasuries holdings held near a record high in April. That was quite interesting. They dipped about $36 billion to $9 trillion, but yet foreign holdings are still sticky for treasuries. So that was, of course, a big risk and a big worry for the long end of the market. So far, so good.
Yeah, so far so good, because at least for right now, where else are you going to go, right? We should also point out another headline on money markets still holding at that $7 trillion level here. And it gets to a big question as to sort of what the next catalyst is for this market. With the Fed doing nothing, we're probably not going to get anything out of them until we get to the fall. I know we have an earnings season coming up, but this really puts the eyes back on geopolitics, back on the situation in the Middle East, and of course, back in the situation in Congress with regards to that budget bill.
Yeah, absolutely. Check. I think you hit all of them. I was just looking again at JP Morgan when they report earnings, and it's July 15th. So I feel like that's going to be a big one in terms of what kind of outlook.
Yeah.
Well, it's not that far away, right?
Yeah.
But I do think
my
the next.
birthday's shortly after that.
Is it? When's your birthday?
Yeah, so just mark it.
What kind of cake do you like so that we forget to
He's
get
not
you
saying.
one?
I'm healthy. No problem.
I'm just kidding.
Just carrots and hummus.
Yep, that's my lunch. You're doing gummy bears. A gummy bear cake. That's what's coming.
Thank God for the food court.
Has anyone
man.
thought of that?
We're also going to hear from Powell next week. He's testifying, so
Yes.
maybe we'll hear more there. But given what we heard today, I'm not optimistic that we'll get any more details. I'm still waiting. I guess what I'm curious about is where he's seeing strength in the labor market. I guess it has to do with the unemployment rate and what we're seeing with non-farm payrolls. He was asked a lot of questions about the labor market with specifics to the ICE raids that I thought were really interesting, and immigration, but he said it's not, Fed policy to comment on these things.
Yeah.
To be fair, there is a gummy bear cake, but the gummy bears are on the outside of the cake.
Yeah, I'm trying to,
Okay, how did you get them on
trying
the
to keep us
inside
on
of the cake?
task here.
Well, you
Come
can do a
on.
hole in it and then
This
put
is
the gummy
this
bears
is
in
the
it.
this is the technological
I can make it for
innovation
you.
we really need.
I don't
We're
think
talking
this is what our
about David
producer-
Sachs and
Yeah.
Coinbase and Circle and all that. Come on, man, gummy bear cakes.
I can
that
make
would
this
move.
for you.
That
I
would
can
move.
totally make this for you.
No.
Would bring peace to the world.
That just seems so wrong.
You better get those while you can before all the dyes are not
It
allowed
is right.
anymore.
I forgot. Yeah,
You heard there are a couple
RFK's
other
trying to ruin our
companies.
fun.
Again,
Just
bringing
can't
this
drink
back to
Kool-Aid
news.
anymore. Anything?
A couple
Fun
large
Dip.
companies
Remember
out
Fun Dip?
this week saying they're not going to be using these dyes anymore at the end
Tim
of next
doesn't
year.
remember.
This alone
he's too young.
says it was not an important Fed meeting.
Yeah.
Right. Yeah, this conversation says it all. Thank you.
Oh wait, were we supposed to be talking about the Fed?
Exactly.
All right,
All right, guys.
we got to go, Carol.
We do. I'm trying.
Sure thing.
All right, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals. Folks, Remain and Alex continuing out there on television, and Tim and I right here on Bloomberg Business Week Daily. We'll see you again, same time. Not really same place tomorrow, but on Friday we will see you. All right, take care, everybody.
All right, while the Fed didn't move and the markets didn't move as well, there are a lot of questions out there about what comes next over the next few months. A conversation up ahead with Betsy Duke, former Fed governor and former chair at Wells Fargo. We're going to get her thoughts on what happened today. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Alex Steele.
And I'm Romaine Bostic. And Alex, if you take a look at the board behind me, that really does sum up how the market felt about what we learned today. A Fed standing pat, as we had expected. Modest changes that we saw in some of their economic projections, but a dot plot still guiding towards 2 rate cuts for the year. And that left the markets, at least for the benchmark, unchanged here on the day. The Russell 2000 got a little bit more of a bid, but not much of anything here. Even the 2-year yield, as well as in the belly of the curve, as well as the long end of the curve, we only saw modest drops in yields of about 1 to 2 basis points, depending on where you wanted to look. And even crude oil, at one point it was down about 2%, it was up about a couple of percent, but did settle on the day pretty much where it was yesterday as well, Alex.
All right, let's look at some of the biggest movers of the day. They are related but different. Circle and MasterCard going in very opposite directions here. On the one hand, you have Circle Internet Group rising a big time today after the U.S. Senate passed stable legislation setting up regulatory rules for cryptocurrencies pegged to the dollar. The flip side, you have the Wall Street Journal reporting that large multinational merchants are exploring ways to bypass traditional credit card fees using stable coins. So those two stocks going in opposite directions today. Our top story for the hour, though, is the Fed keeping rates steady. It's still penciling in those 2 cuts by the end of the year. Fed Chair Jay Powell also asked by our very own Michael McKee on his future with the Fed.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Fed Chair Jay Powell there. Very pointed response to a very pointed question. Betsy Duke joins us right now. We're going to throw some pointed questions at her. She's former Fed governor, joins us now to talk about not so much Jay Powell's quip there, but really just kind of the bind that he and the rest of the FOMC members might be in right now, looking at the potential, and we say potential, for higher inflation because of tariffs, and of course the potential for slightly lower growth. And I do wonder, do they have to wait for those things to materialize before they do anything? And if they do materialize, would it be too late?
So separate the tariff question from the rest of the economy and where it's headed. Because if you look at the economy, where it's headed, it does seem to be in a very good place right now. So absent the tariff question, the Fed would be deciding whether or not to move rates down a bit, and they would be projecting the trajectory of inflation to be steadily down. And if you look at that, I think, the big question there from the standpoint of a member of the Fed would be, where do you think the neutral rate is? If you look, there are 7, I think, dots that say no change in rates, and there are 6 that think neutral rate is 3.5 or above. The rest of them think neutral is more around 3, and so they're 0.5 point lower on where they think rates should be. So that's where you have it. But the tariffs have the potential to swamp everything else. And where they originally set is it's an extremely high rate, something we've never seen before. And so it doesn't make any sense to move until that happens. There's nothing going wrong that the Fed has to compensate for now. And so it's in a good position to wait to find out, first, where the tariffs are going to land, and then secondly, how those tariffs are going to play through the economy, what kind of change they're going to create, and how lasting it's going to be, or will it simply pass through?
And I understand the rationale for that. And there was another question posed to him about the dual mandate and whether those 2 mandates start to become in conflict with each other. He basically said that they'll need to assess, of course, how far they are from each goal when that arises. But it gets to the question as to what does that discussion look like over the next couple of meetings if you do start to see meaningful divergence between what's going on in the employment market and what's going on when it comes to inflation?
If you start to see it, then the question will be, which one is further away from its target? Which one is likely to come back the quickest? And what action, any action, how will it affect one? How will it affect the other? And how do you optimize your outcome based on the 2?
So, Betsy, I'm curious as to Jay Powell's point also that inflation from tariffs will, and I'm using the word, not him, basically transitory, potentially a one-off. If that's the case, could any dent on the economy and the labor market also be transitory from that?
Well, he kept talking about the supply of labor, and I thought that was really an interesting point that didn't seem to land as much. But right now, you have not so many jobs being created, but historically, the job creation the employee creation, the participant creation, is about 100,000 a month. So if you've got job creation at 100,000 and participants in the labor force entering at 100,000 a month, you've got a labor force imbalance. For the last couple of years, the increase in the labor force has come from immigration. If you start reducing immigration, and I've seen some speculation that net immigration could be negative for this year, then you have fewer participants in the workforce. And if you have the same number of jobs created, you actually create tension in the job market. So it's a supply and a demand story, I think.
We also just saw a chart of continuing claims. We've seen that sort of tick up as well, the 4-week average as well. When does that start to become a worry if you're sitting at the Fed?
Again, if you're looking at 4.2% unemployment, if you're looking at labor force and jobs creation being basically in balance, it doesn't create a problem. When you start to see those move significantly, then there might be some concern, but I don't see it at this point, and I don't see the what's going to cause it right now.
I do want to get your thoughts, Betsy, just on kind of the inner workings right now of the Treasury market, liquidity issues, and the news that we had coming into this morning about the potential easing of the supplementary leverage ratio. Jay Powell wasn't really asked about it, didn't really address it. But I do wonder, when you look at just the general health of the Treasury market right now, and more importantly, the participation of the big banks in being able to, at least in their view, being able to do more, I am curious if you think that an easing of those rules, of that percentage cap, is going to help.
So first of all, even when I was at the Fed and we were coming up with the capital rules, I was not in favor of supplemental leverage ratio. The leverage ratio, which is just an equation of capital versus total assets, is the roughest, least accurate measure of capital that you can have. So when we started discussing including a supplemental leverage ratio, I made the point very, very strongly in public meetings that we definitely should not include reserves as part of the asset part of that equation. And I think really you can make the case that we should not include short-term treasuries in the asset part of that equation. So at a minimum, I think they should modify the ratio to exclude short-term treasuries and reserves as close to risk-free assets as you can get. And then that would leave the banks free to use their balance sheet to balance out the Treasury market.
How much do you think that is constraining the Treasury market?
Well, for any bank where the supplemental leverage ratio becomes binding, it's an issue.
How much of an issue, though? I mean, like, is it really distorting, say, the Treasury market, really distorting their borrowing abilities?
Well, no, but if you're a bank and you are capital constrained, you are not going to add a low margin asset to your balance sheet. You're just not going to do it. So it is constraining their willingness to invest in the Treasury market.
I see. Okay. And lend, I should say, not borrow, but lend. All right, Betsy, thanks a lot. Betsy Duke, former Fed governor and former Wells Fargo chair. Thank you very much. Coming up, we've got a big lineup on deck as we stay with our Fed coverage. Andrea DiCenso of Loomis Sayles will be joining us. Vincent Reinhart of BNY Investments and former Kansas City Fed President Thomas Hoenig joins us with their takes on the decision and the market reaction. This is The Close on Bloomberg. Watching the markets after the Fed's decision to leave interest rates unchanged. S&P closing pretty much flat on the day. Tech and utilities, top sectors on the day. Energy, communications lagging. Want to bring in Andrea DiCenso, co-portfolio manager of Alpha Strategies over at Loomis Sayles. It was a nothing burger. What is the read-through then, if you got to trade, on what Powell didn't say?
I think my main read-through is that he put the ball firmly back in President Trump's court when it comes to the future path of inflation. We have 7 voting members saying no cuts whatsoever because they're concerned that inflation is on the horizon. So if President Trump wants to see those cuts that he was speaking about earlier today, perhaps when he starts to think about that 90-day tariff relief pause that's right up around the corner, he might want to be thinking about what is the impact of the effective tariff rate going to have on that Fed path going forward.
Oh, wow. So there's a lot more connecting the dots from that point. So as an investor, does that make U.S. credit, U.S. Treasury market, a good investment thesis?
I mean, I think U.S. Treasury market can be interesting, especially when we see the 10-year, creep back up above 450. Certainly when it was trading at or around 475. We always like to think about where should the 10-year be trading. Think about the forward path of Fed funds plus the term premium. If you look at where the dots were today, looking out at 2026, they're looking just above 350 on the forward path of Fed funds. And right now, as it stands, the term premium sits at about 70 basis points. So treasuries could be an attractive investment around now, but what we think is ultimately attractive at this point is looking at emerging markets, looking at non-dollar opportunities, because investors have shown they have serious trust issues right now with the dollar.
Well, certainly so. I mean, we're talking about a dollar, down 10% or so just to start the year here. And while we did see a little bit of strength on the day, it seems like the long-term trajectory is still to the downside, at least if you believe the positioning in markets. And I guess my question, Andrea, is why? Is that is there more to come, or is the market, should I say, expecting more to come that would tamp down the dollar, or is this just simply a tactical play?
I don't believe that this is a tactical play. We're in the camp of we are seeing a de-dollarization trend that's likely to continue to pick up steam into the second half of this year and into 2026. We just got finished with what could have been a decade of U.S. exceptionalism, and now that trade is certainly under scrutiny. When you look at the returns that you've seen across global equity markets, global fixed income markets since Liberation Day have clearly favored outside the U.S. investors putting money to work across those global economies. So as we look out, we have the one big beautiful bill, still a tremendous amount of uncertainty around that July 9th date coming up upon us with no clear picture of where we're headed, not to mention Israel, Iran, and just the uncertainty we're seeing from our own Fed governors. It's fair to assume that investors are going to put money to work where they're more confident around the path of growth and central bank action.
This gets to the question when we look at the outperformance this year by, let's just take emerging markets. So if you just take the MSCI Emerging Market Index, and I know there's a heavy China weighting in that, but when you look at just how outsized that outperformance has been, it raises the question as to whether that rotation into some of those assets was done as something temporary or transitory, the idea of protecting yourself until the U.S. figures out whatever the heck the U.S. is trying to be, or whether this is long-term structural changes, long-term structural reallocations.
I think that's a very fair point. But as we sit today, we want to think about a 6-month horizon. And I think what we just got from our Fed governors is they are super focused on this outcome, and even they have a tremendous amount of uncertainty. So as an investor, you're going to, again, look to where you believe you have the highest probability of achieving favorable risk-adjusted return. And I still think at this point, that is favoring an ex-U.S. investment base.
Where ex-U.S.? Is that going to be emerging markets, ex-China? Is it going to include China? Is it going to be Europe?
I think at this point, we are really focused on sub-Saharan Africa when you're looking at global fixed income markets, along with Latin America. If you think back to that Rose Garden display, many Latin American countries were left off that tariff board. And that's really important from an investor-based standpoint, that they don't need to wade into who is going to be tariffed at what rate. When it comes to China, though, we still have an outstanding tariff pause between the U.S. and China. So we still believe it's a little bit early to be stepping into that market. The same with Europe at this point. Yes, they have a favorable fiscal spending package that's likely underway. Yeah. They have their own cutting cycle that's well underway. However, their tariff policy with the U.S. is going to matter tremendously on their growth outlook.
All right, Andrea, I have to leave it there. Great stuff. Andrea DiCenso over at Loomis Sayles. As we continue to sort of refocus here on what comes next, we talk about the individual daily moves on the back of that Fed meeting did not move the market. The Fed did stand pat on rates. It did stand pat on the dot plot, but it did make some revisions to its economic projections. A conversation with Vince Reinhart is up next.
That parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed. And
Fed Chair Jay Powell saying the Fed's waiting to see what happens with inflation as the latest dot plot forecasts fewer cuts in 2026 and 2027. Despite this, our next guest says their projection was a little bit more dovish than expected. Vincent Reinhart joins us right now, the former chief economist over at BNY Investments. And Vince, there's been a lot of talk here about the idea that they did revise up those inflation expectations for this year. But when you kind of go a little bit further out into 2026, 2027, I know it gets tricky with these forecasts here, things get a little bit different, let's just say.
Well, I think at this point, Chair Powell would begin to put pinches of salt about the forecast. It's not a contract. It's individual FOMC participants. We also don't know what else they're basing their forecast on. They could have, for instance, very different views on what happens to oil prices or what happens to the exchange rate. My problem with the forecast is it doesn't square. It's not internally consistent about 2025.
I am curious, Vince. I mean, I'm curious about what the discussions are going to be like over the next couple of meetings. And you spent, more than 2 decades at the Fed in various roles. And I want to hone in on something that Powell said, particularly when it comes to the labor market. And he said basically that if you're out of work, it's hard to find a job, but there are very few people who are being laid off at this point. So that's an equilibrium that we watch very, very carefully. What is the conversation around that sentiment when they head into the next couple of meetings?
He also said that the labor market was not crying out for lower interest rates. So, look, I think the main message you have to take away is the FOMC is data dependent. They've seen some tariffs effects. They expect some more substantial, if you listen to Powell sometimes during the press conference, not as much at other times. And they're going to play it as it lays, i.e., what happens to that. To the data on inflation and unemployment.
Vincent,
my problem. Sorry, Alex.
No. Go ahead.
No, I mean, my problem with the forecast is, as you noted, they marked up their forecast for inflation in 2025. That by itself, by most monetary policy rules, would say that the appropriate funds rate should be higher than it was the last time they did their forecast. So either they were right in March, or they're right in June. They can't be both.
But that doesn't mean that they should hike. That's not what you're saying, right?
Oh, no, not at all.
Okay.
I think the Fed's got a plan, right? The plan is when inflation moves assuredly lower toward its goal of 2%, they're going to adjust the nominal funds rate. They don't want it to get higher in real or inflation-adjusted terms. They want it to be somewhat restrictive because they're not at goal yet. And so the question is the timing of when they do those adjustments. What they said was the timing is the same on net in 2025 as they thought the last time they did this forecast round in March.
We heard Powell use the word uncertainty quite frequently. The idea that this is a Fed that is going to have to do a lot of scenario analysis for situations that are really going to be very fluid, particularly coming out of the White House. I am curious as to whether you think the Fed is going to have the luxury of actually being able to wait in the way that Jay Powell communicated today.
Two parts to that answer. The first, let me turn it around and ask the journalist a question. If uncertainty is such a big aspect of the outlook, why did they say that uncertainty had gone down over the intermeeting period? Sure doesn't feel that way. The second is they got to expect criticism. They got criticism just before the meeting. They will get criticism tonight. They'll get criticism over the weekend. It's not about them having the luxury about their timing of policy rate cuts. It's rather them having the fortitude to do it when they think it's appropriate.
Here's an unfair question for you. Clearly, Fed Chair Jay Powell has been getting a lot of heat from President Trump. Clearly, the Fed doesn't want to cut right now. How much of that is just saying, look, you can't bully me around. I'm going to stick to our pace and we're not going to do what you say. How much of that is really playing in the background?
Hard to tell. I mean, there's a certain irony, exactly as you say, about criticism. What it does is it strengthens the resolve of the person who's criticized. It also brings members together to support their embattled chair. So I think, in fact, the criticism blows back and makes the FOMC a little more resolved in what they're doing.
Have you been relatively pleased with the way that Powell has handled himself in the face of some of these criticisms?
I answer the question much more favorably at 1:59 this afternoon than at 2:01 because I don't quite get the summary of economic projections. I don't actually think they'll cut 2 times in 2025. The data is not going to allow them. I know the plan. I think it's appropriate to lower the nominal funds rate as inflation falls back to goal. But there are more tariffs than what they anticipated back in March. Inflation's higher than what they anticipated back in March. And inflation is probably going to go up more than they think. They want to cut rates. I just don't think they'll be able to cut them as much as they want.
Because of that higher inflation. And Vincent, always a pleasure. Always love chatting with you. Vincent Reinhart, chief economist at BNY Investments, obviously spent many years also at the Fed. All right, well, we made it through the Fed day with a whole lot of nothing happening across the markets. S&P unched. I'm going to say unched.
Unched.
Yeah, let's do unched. You got tech a little higher within the S&P, energy a little lower, but nothing to write home about. VIX standing firm at 20. Also, let's just go unch with the rest of it. I mean,
let's go
like
unch. Yeah, I mean, I think Tom Keene's rolling over in his bar stool right now.
He is. Yeah. It's true. It's all unch, guys. All right. This is the close on Bloomberg.
We have to be forward-looking. And the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months. And we have to take that into account. So I think a backward-looking look would lead you to a neutral stance.
Now, as Fed Chair Jay Powell speaking to reporters moments ago, a meaningful inflation expected in the months ahead. Former Kansas City Fed President Thomas Hoenig joins us now. It's great to get your perspective because you're data dependent, right? Fed's data dependent. The data seems to be saying it's okay to cut, right? Growth is holding up and inflation is also cooling, yet they're not data dependent because they're looking at forward potential inflation. I don't get it.
Well, I think, first of all, the word that Trump used appropriately was increased uncertainty, and the uncertainty is palpable. I mean, it's everything is up in the air right now relative to tariffs, which they mentioned over and over again. So that's a major factor, and I think that's really driving it. Now, the other thing, I'm not so sure that rates are all that restrictive right now. When you look at it, the real rate in the economy is about 1.8%, let's say. That's not all that restrictive in the scheme of things in the long run, especially. So they really need to be cautious, and they're seeing that inflation is likely to rise. I think that's a real issue. The one thing I thought that was missing was there was only one question on fiscal policy, and fiscal policy is going to have enormous more debt. Fed already has a balance sheet that is trying to be reduced at a very time where the pressure to increase it will only grow given the size of the debt and the need to place it. So they have these other factors that weren't really brought up today in the meeting. I understand why, but those are other factors that I think will play into the future as far as whether they can cut rates or not anytime soon.
So do you think the Fed can get to the 50 basis points for this year, or no, based on those two competing factors?
I think it's no. I think inflation is their bigger issue. Inflation by tariffs is obvious to everyone, but there's another force of the inflation, and that's the inflation of fiscal policy, which they, as they continue to work with this bill in the Senate now, and coming out with what they think are spending cuts, when in fact the debt will still increase as a result of this deficit, and that's going to put more pressure, upward pressure on interest rates as we go forward, and put more pressure on the Fed. So they better work through things now that they can and bring inflation down, and certainly not let it get out of hand with these tariffs and other factors. So I think they need to hold where they are, and they're doing the right thing at the moment.
Okay. Thomas, I just want to play real quickly a clip that we had from the President of the United States earlier today. This was prior to the Fed meeting when he was asked about cutting rates and, more importantly, about how tariffs fold into all of that. Take a listen.
Because of this guy's rates, if he'd lowered a point, I'd pay about a point less. Then if he'd lowered 2 points, I'd pay about 2 points less. And that's for 10 years, 12 years, 15 years, 5 years. It's hundreds of billions. It's even trillions of dollars that we're going to lose because of this. Too late. I call him Too Late Powell because he's always too late.
And I know, Tom, it's, look, there's a lot to parse out of that, and we don't have to get into the dynamics of the accuracy of what he said, but just the general sense here that if the Fed were to embark on a truly meaningful rate cutting cycle, given the fiscal pressures, given the potential for tariffs to be inflationary, would that really have any sort of immediate impact in the secondary market on rates?
Well, I think it certainly would. I think, number one, it would destroy the credibility of the Fed, because if you began lowering rates in a systematic way at these levels, people would say, "What in the world just happened? They just caved. This is very inflationary likely," and I think you're playing a gamble there that somehow lowering rates is going to take care of your tariff problem and your inflation problem, and that would be a serious mistake on the Fed's part. And I don't think it'd be good for the United States at all.
But this gets to another question. It's a sensitive topic about Jay Powell's tenure, the idea that Trump wants to replace him, whether he does that before his tenure is up next May. The market is already starting to look ahead to that, with the idea that anyone that Trump picks is going to have to be somewhat dovish. At least that would be the assumption, that Trump wouldn't pick anyone that wasn't going to come to the table committed to potentially lowering rates. And I'm wondering if that's going to distort and distract and make it harder for the Fed under Powell for these next few months to actually do their job in the way that they would want to do it.
Well, I don't think it necessarily undermines there, because they're determined. It appears to me at this time they've explained themselves pretty well. I wish they would mention the debt more often, but they don't. But they're still saying we're not moving. They did move the inflation projections up modestly and the GDP down. Those are all things that make sense right now. So I don't think it would undermine him. I think it might hurt the market in the sense that if you know that you're going to have someone who's going to change that dynamic to, accommodate the wishes of politicians, then you're going to undermine the confidence of the market in a future Fed, and therefore that'll begin to play into the market, I think, sooner rather than later.
Take us to what it's like being in the room facing criticism from the president. I understand that Fed officials are going to ignore it and do what they think is right, but that's got to be something. What is that like?
Well, it's very stressful. Is the only way to say it. Look, no one wants to say no to the president of the United States, and no member of the FOMC wants to say no to the chairman if they can come to a consensus. But for the chairman particularly to face the criticism, face the president, face the politicians more broadly over time, it's very stressful. And he certainly has to be feeling that right now, and will for the remainder of his term, I'm going to imagine.
All right. Well, Tom, we really appreciate you taking time for us. Former Kansas City Fed President Thomas Hoenig there as we continue our post-Fed coverage here. A market right now a little bit listless, a little bit in stasis, but we should point out there's a lot more going on out there that could actually move this market, whether to the downside or to the upside. Of course, all eyes still on what's going on in the Middle East. And we did learn just a little while ago that the President of the United States was scheduled to meet once again with his national security advisors to discuss what U.S. involvement would look like in the conflict between Iran and Israel. Of course, that could have an impact on energy prices and could have an impact on economic conditions and financial markets as well. Scott Chronert joins us right now, U.S. equity strategist and global head of ETF research at Citi. And Scott, I do want to start with geopolitics. I know that was kind of on the back burner today as we all focus in on the Fed and Powell, but my guess is over the next 24, 48, 72 hours, we're all going to be obsessing once again about the situation in the Middle East. And I'm wondering if yet there is any sort of real drag on financial markets here in the U.S. as a result of what we already know.
Well, Romaine, it's a good question. I think the market's telling you that so far, it's viewing the situation as mostly contained. When we look at these global geopolitical, hotspots, the first place we go is, okay, let's presume this goes on for a while longer. What's the impact going to be on global macros? What's the global GDP forecast look like in a scenario where you begin to push this out a little bit longer? What we've learned with Russia-Ukraine and more recently with Israel-Hamas is that not much of an impact actually plays through directly. So you look at the indirect impact, and here the most obvious one is oil prices and energy right now. But all told, the market's telling you that this is a fairly contained situation. Now that's relative, and that speaks to a certain component of what's going on here that has much more far-reaching implications. But generally speaking, we look at the S&P 500 in particular through a fundamental lens, and we don't see too much changing based on what we know or think we know about the situation right now.
In fact, didn't you and your team just recently lifted your S&P, your year-end S&P target to, I believe, 6,500, which certainly puts you out in front of a lot of folks. But we've started to hear a lot of folks, even those that haven't actually formally lifted, saying that they probably will lift. And some are even going as higher beyond 6,500, Scott. What would be the driver for that? Is that just corporate profitability holding up?
Yeah, so the way we're talking about it is that we completely expect policy volatility to persist. This is going to be ongoing, and it's going to be a function of some of the tariff discussions as it plays through the budget work and the deficit discussion as well, in addition to global geopolitics. But in the meantime, we'd say that fundamental volatility is much less, and you saw that through the Q1 reporting period. Now, importantly, what's come back into the picture here that we have to acknowledge is sort of a resurgence of the AI tailwinds, the spending on AI-related infrastructure that's driving a big chunk of the market cap of the S&P 500. So this underlying influence of infrastructure spend related to AI and new technologies continues to underpin a big chunk of the market. Now, in the meantime, the part of the market that's been left behind, quite honestly, through all of this has been the rate-sensitive part, whether it's the home builders, whether it's sort of areas of the financials. You look at areas of the consumer as well. And so that sets up for a discussion later in the years. Potentially, we do get to some Fed easing that takes some pressure off of those parts that have been laggards so far that could step back in. All told, the bottom line here is our ongoing messaging is that as we step back from the tariff cliff of Liberation Day, we get a little bit more comfortable that we can manage where some of the country-specific tariff policy actions are taking us, and tariffs in general become more of a company-specific, maybe industry or sector-specific issue, more so than an aggregate index issue.
Okay, to that point, in terms of sector issues, could defense, though, get a boost from what we're seeing with Israel-Iran, but also more spending, say, from Europe?
Well, I think it has to, and I think defense is a great example where you have to presume that there's going to be an underlying spend dynamic that's going to be at play here, and whether the spending is to U.S. companies or other parts of the world, particularly Europe, it's all going to be part of the same discussion. And what you tend to get with those defense companies is you get a longer lived, project life. That means that you can look at these companies through a much extended lens in terms of what you're discounting back into the price action. So all told, I think we have to presume that there's going to be an underlying bid to the defense parts of the markets as this situation plays out. Obviously, with some short-term volatility. Honestly, that's one part of what's been keeping the industrial sector of the market up, which has been a pretty big surprise to us so far this year.
All right, a quick one before you go. In terms of, say, higher oil prices, will higher oil prices be enough to boost energy earnings?
So energy has been the biggest drag, if you will, from where we started the year, Alex, in terms of the earnings picture. We went into the year thinking that the energy sector would show earnings growth in the high single-digit range this year. It's looking now like we're talking, well, year to date, you're down mid-teens. So it's actually, as S&P 500 earnings go, it's been the biggest drag incrementally on the index. So what ends up happening is this dual-pronged approach to the impact of higher oil prices. I get it. It has a inflationary read-through that we have to pay attention to. But at the same time, it does kind of buoy that part of the index that so far has been struggling for an earnings catalyst.
All right, Scott, we always appreciate you taking time for us. Scott Chronert, one of the best in the business, U.S. equity strategist and global head of ETF research over at Citi. Some breaking news right now. This in the world of sports, this in the world of sports business. We're learning that the Los Angeles Lakers may be sold. ESPN is reporting that the Buss family is entering an agreement to sell a majority ownership in the LA Lakers to Mark Walter. Of course, he's the CEO and chairman of TWG Global. Again, this is according to people familiar with the situation that spoke to reporters over at ESPN. This will be a big deal.
Huge. And isn't it valued, Lakers, at like over $6 billion at this point?
Well, remember, we had the Celtics and a couple other teams that already just recently got valued at that. I think some would argue the Lakers would probably demand a much higher valuation than that. These are record-breaking numbers that we're starting to see in professional sports, first in the NFL and now in the NBA. Once again, ESPN reporting that the Buss family entering an agreement to sell a majority stake in the LA Lakers. We'll try to get you some more details on that, and when we come back, we'll set you up for what to watch over the next 24 hours. This is Bloomberg. All right, let's set you up for the market action over the next 24 hours. And if you're in the U.S., there is no market action.
Well, yes, good point. But you can trade equity and treasury futures.
Oh,
Even though cash markets are closed, tomorrow the futures will be open.
Juneteenth holiday here in the United States, but there is going to be some action overseas, including in Switzerland.
You didn't believe me, but Swiss National Bank is likely to lower interest rates to 0 this week, but avoid those negative rates.
I learned this during the commercial break, lowest policy rate of any major country, and then the Bank of England also set for a rate decision as well.
Probably nothing, because UK inflation is still a little bit sticky.
They're definitely not going to 0. A lot more coverage coming up here on Bloomberg with a closer focus on what's going on in Washington with our team at Balance of Power. That's up next on Bloomberg.